afternoon, guys. I think we had a wonderful day so far, and I suppose we're all convinced about the India story. I don't think we need to sell India anymore. Uh, NRIs are going to come back to India investing in a big way, uh, just not in equities, but I think fixed income and other alternate assets are real big opportunities, and which is what I'm going to discuss with this esteemed panel here. And we're going to get a lot of insight in terms of how, what should be investing in. And there are some extremely innovative products which some of these guys have come across, which are far more attractive than some of the traditional products which the NRIs have been investing. I think the most popular product amongst the NRIs is investing into Indian fixed deposits, which is an irony, which I believe is an absolutely uh, underperforming or inefficient product, but we continue to invest. So here we are going to discuss something very interesting and look for opportunities which possibly the Indian government has opened now for NRIs, which is investing into all possible asset classes besides few kind of few things which you can't. But I think overall it's a very exciting opportunity which today we have. I think all of us are convinced about India, so let's focus on the products which we have, the opportunities which the NRI community has to invest in this. Obviously, things keep running in our mind, Indian rupee keeps depreciating. So all of us feel that investing into Indian rupees may not be a smart thing, and which is where I think most of us have come up with dollar-denominated products. So I'd like to kind of start with Karthik and kind of tell us what should an NRI really invest into? Why should they look for India as a destination for several products, whether it's fixed income, whether it's real estate, debt, or so on. So just kind of love to hear from you.
Sure. Thank you for PMS Bazaar for giving us this opportunity. I think our topic comes after a whole day's growth and equities and all the excitement. And honestly, the previous presentation by Saurav is a pretty hard act to follow. And I'm a little disoriented myself. He took me to some euphoric highs. But actually, we have to come down in feet on the ground because that's what this topic is, credit. And credit, you got to have your feet on the ground, and everything that was discussed from 9:30 this morning up until this minute, honestly depends on, how the credit plays out. Because, if the credit doesn't work, the equity certainly doesn't work. So, we represent a part of the cap structure that I think is crucial to India's growth story. So my point is anybody who's interested in India growth, India equities, has to be interested in India credit. So from that perspective, India itself, just to quickly get into this market, is fundamentally, when you compare it to any developed market, by definition and by default, a high yield market. So, if you see SBI's PLR, it's today around 14. And, in most parts of the world, that's considered high yield. And, essentially, when you actually look at India as an opportunity across the spectrum, whether it's plain vanilla loans, an ability to participate in, as Milan said, and what we do, our specialized credit funds, we have two themes running. We have a real estate credit fund, and we have a corporate credit fund, which does mid-market lending. And all of them are pretty interesting topics that signify, just as in the case of India, structural shifts on equity and growth and everything. A structural shift is happening in credit, where clearly, just to give you an example, the US credit market is roughly around 20% bank financed and 80% non-bank financed. In India, the ratio is exactly the inverse. So there's a massive opportunity for private credit and non-bank finance to get into providing credit to a variety of situations. And within this, I think India also has situations where banks cannot lend either because of commercial sense, their own cultural philosophies, the history of the past, and also regulatory arbitrages, which I think many of the speakers sort of alluded to as areas or pockets of equity. So we operate in those sort of spaces where the idea is to generate consistently in rupee terms, and we'll talk about the FX, and I think Vineet will address it, we're sort of dividing. Pure credit asset level returns of 18 to 20%, are possible to achieve through being asset backed, through being cash flow backed, taking advantage of the massive opportunity size, regardless of, the kind of underlying opportunity there is. And fundamentally, that's a massive equity type return with protected downside that is available as a market in India. Now, the question is, how do you sort of package it and make it available to NRI investors, global investors on a dollar basis? We can talk about that. Simultaneously, just as a trend, the creditor protection, over the last 10 years, I've been doing stressed, distressed, performing credit and a variety of structured stuff over the last 17 years. And I feel over the last 7-8 years, with the advent of things like the Real Estate Regulation Act for real estate or the NCLT-IBC for corporate credit, creditor protection rights clearly as a momentum is shifting towards, better rights for investors and lenders. And that by definition, becomes a very, very strong comparison, between markets like perhaps here, to India, where you can get asset level returns of this much, and how do you sort of structure for FX is really the only question that's left. So it was not the earlier case where market is so opaque, non-transparent, you had no ability to access. So today, with the advent of the AIF market and the private credit market, there are enough managers with local skills, maybe not a lot, but a few, who have the ability to assess risk, are able to underwrite with credible policies, significant skin in the game, who can generate asset level returns like this. So I think it's a great opportunity and a time for investors to start looking at some gentle uplift on their allocations towards India credit.
So thank you, Karthik, for this. Just wanted to actually add on this, and I'd love to hear from Vineet, is most of the NRIs actually get confused whether they should invest in the country they're living in or the home country, and which is where they're not really sure, or they kind of go ahead and invest into products which are non-India based, because somehow the confidence somehow on India is not there, which is what we're trying to bring in. So how do you kind of kill that dilemma for them,
I think that's a question we get asked all the time, that should the capital that is sitting over here be used to invest globally, or go back into the country that you came from, right? And I think, frankly, these decisions have been driven by three factors that we keep hearing about. The first is liquidity, the second is leverage, and the third is data and the confidence that data can build, right? And let's spend some time on all the three. Liquidity is today lacking in Indian markets because corporate bond markets are not as evolved as maybe many of the Western counterparts are. So the so-called 14, 15 to 20% opportunities end up being relatively illiquid, right? Which means that once you put in your money, you're locking in your money for a year, 2 years, 3 years, whereas potentially you could create a portfolio of South American and many other country government bonds, get 7% returns, but with the ability to take your money out, right? Not incorrect. Having said that, what we see in most credit funds is that the counter to that is MTM volatility that gets associated with that liquidity, especially when the governments you choose to create your bond portfolio are in the BBB category. Volatility in the segment has been very high, and that has very often resulted in both leverage getting pulled out or returns getting decimated, versus the kind of stability today that performing credit funds can offer to you with the lock-in. The second question we get asked of is leverage. Investing in a relatively more liquid bond portfolio that is there from other countries or other domiciles can get levered 1x, 2x by your private banker, and therefore effectively take a single-digit return to a double-digit return. Not incorrect. Having said that, today Indian fund houses are slowly building the capability to have internal leverage within the product. Internal leverage, by definition, is much more stable than the leverage that a private banker can offer their client. Because private banking leverage is merciless. If LTV is not met, the asset is sold, it is available in the custody of the banker, it will get sold. versus internal leverage that is typically like a corporate loan is much more stable and unlikely to be treated the same way as unit leverage might be.
Right.
The third is on concerns on governance that constantly exist for the right reasons, right? Now, we as internal participants in the market see things very differently. I was on a recent trip to various parts of Asia to understand those markets better and came back with a view that the kind of data that today we hold on Indian corporates, right, is mind-boggling, right? India today has the highest data penetration in terms of credit rating coverage, in terms of taxation. We heard Saurabh speak about GST, right? In terms of data coming in on a company's legal cases lying in any court of India, in terms of whether a company has missed a pension payment, that gives you a sense that there is a liquidity concern. The kind of data available today on Indian corporates is mind-boggling, right? There is no comparison. I visited countries all over Asia to understand whether the kind of data structures that they have are even remotely comparable. There is no comparison. It means that for someone like a Sundaram, someone like a Vivriti, and many of my colleagues over here, the kind of tools available at our disposal to take decisions are much higher than anybody in this region or any other region, right? And I would argue that it is probably a step ahead of even Western economies. So these are my responses. I think the questions of the concerns are well taken, and I would think that on all these three fronts, we have come a long way.
Yeah, great. Actually, I like to come to Ram and then I'll come to you, Vishal. So Ram, you've been in Dubai, and I'm sure similar questions a lot of folks would be asking you, and I'm sure you'll be facing on a day-to-day basis. And I assume you're selling more products which the cash flow goes to India. So what's your experience, and what do you want to kind of react to that?
Yeah. So thank you for that question. But before that, just want to say thanks to PMS Bazaar for giving us this opportunity to share our thoughts.
Sure.
On your question, as you rightly said, we have been here since 2011.
Right.
And I can see a huge difference that we have seen the way NRIs have started looking at investing back into India.
Great.
Till 2011, 12, maybe till 13, 14, I would say they had a lot of emotional attachment. They still have, but they would do a lot of fund remittance to India.
Right.
And largely looking at investing back in India, whether fixed income or equities or alternates, real estate
Right.
and so on. But I think what has happened, if you go back in history, right, like last 20 years or 30 years, and you look at the data, you will realize that Indian rupee has depreciated versus US dollars by an average of 2.5%, 3%. But last 10 years, the depreciation is almost 4.5%, 5% per
Right.
annum. This NRIs as an investor class has also looked at and realized that we must divide our portfolio asset allocation in two parts.
Right.
The one part is that we need to send to India
Right.
for maybe support back in India, or they still have their businesses, or they still want to own homes in India.
Sure.
And so on. That asset allocation that they have to send to India, I don't think they're too perturbed or bothered about the currency depreciation, because
Right.
that has a usage back in India.
Right.
The second asset allocation, which is about the financial allocation,
Right.
that's where a lot of these guys have started wondering whether we should send money back to India, because maybe at certain point in time we may need to bring it back here.
Right.
And then see the suffering
Right.
of the rupee versus USD. And that's where a lot of these guys, that, as he was saying in this part, a lot of these guys have also started realizing the importance of leverage. They started realizing that if they keep the money in USD, at least they do not see the depreciation on that asset allocation.
Right. Right.
Again, so this is two parts on the NRI asset allocation, but then we also divided it into two products. So one is the fixed income, second is the equities.
Right.
When it comes to equities, our experience has been that investors are willing to take a call of
Right.
saying that I am okay even if I lose 3-4% every year on my equity portfolio, because India as a country, as Saurabh was mentioning, is giving you stupendous returns, right? Globally, one of the best performing equity markets. So if for next 10 years, your expectation is that you will make almost 15% returns in India, you say, even if I lose 3-4%, I am still double digit.
Correct.
Which is probably I am not going to make anywhere else.
Correct.
And hence, I am okay with that kind of depreciation.
Correct.
But if it is about fixed income, and in India, fixed income, I am expected to make, let's say, 7 or 8% in today's time.
Right.
It was less few years back. And if I lose 3-4%, then my dollar returns on fixed income are much lesser. And
Right.
that's where probably the leverage kicks in. They started looking at dollar denominated solutions, which can
Right.
help them either through hedge or through leverage tide over some of these challenges of rupee depreciation.
Great. Thanks, Ram, for this. I'll come to you, Vishal, and love to know, as you guys have been primarily into venture debt, private equity, uh, basically all alternates, and primarily your customers are generally not based out of India. You've been kind of doing more business. What are your thoughts? Why should they invest into a venture debt kind of a product? Why should an NRI look for a venture debt? What is it? Could you explain to them how popular it is in UAE and so on? I'd love to hear from you.
Okay, I'll begin with firstly thanking PMS Bazaar team here and the audience here for building this great event. I'm sure this is just the beginning and we'll have series 2 and series 3 in years or time to come. Coming to your question about the business, what we do and specifically venture debt, that's the newest offering which we have brought on the floor. In fact, next month is when we are launching the first one. We have done venture capital investments in past. We did fund on the equity side, but as we all know that for now there is a funding winter in the VC equity space. We see much more credible opportunities in the debt side. The reason primarily is because of the valuations. We feel that the kind of uncertain environment today is, we have not been deploying capital. In fact, I may say to the extent that in the last 1 year, 22, the last investment we consummated was in January. So for last 1 year, we have been sitting on cash to find the valuation of our choice. Okay, it's not that we are not getting the opportunities. We love the work being done by the startup space, and I think it's I think this audience may be well aware about what's happening in the startup landscape in India. We are the, you may say, second startup capital in the world where the action is happening. And people are doing some extraordinary genius work, just that in terms of what's being expected in terms of valuation, we feel in the big shift which is happening, or rather has already happened in 2022, we have to set the market realities in terms of what the promoters are expecting. And because I'm in a fiduciary role to get the best possible return for our investors, we feel today the opportunity is more on venture debt. Before elaborating a bit more on that, I may take a little bit on the alternate financing or alternate as an asset class. We need to from since morning we have been hearing about India equity. I think someone must be living under the rocks to not be knowing about what's happening in India. And yes, India equity next decade or next few decades would belong to India as an economy, as a market. At the same time, the opportunities which are posed by other asset classes, especially debt, and alternate, which is being now more sought after as we speak. We primarily cater to more HNI and UHNI space, and that's where so-called smart money moves in. I think for entire 2022, when if we track the markets, the equity was down, fixed income was down. So if you realize US Treasury, okay, which is considered to be the safest asset, that was down by around 19% for the year.
Correct.
Okay. So the market kind of had a huge pivoting over last 1 year. Alternate became a big flavor. And when we say alternate, everything as a broad classification, which is besides equity and debt, which are the traditional asset classes, goes into alternate segment. And there I may add the shift, I may say tectonic shift, which has happened in India, especially on the fixed income markets over the last 2 decades. So originally the banking, which you know, which was giving this capital to promoters, and for various reasons, what we know, how they have created the huge NPAs. It was not the most efficient way of giving capital. Then came a mutual fund, which became a huge industry in itself. And the AUM for the mutual fund industry, the way it has risen, especially in the last decade or 2 decades, I think that's speaking for itself how capital has been given. And now I would say the third generation which has come, wherein the new generation, my colleagues Karthik and Vineet, how they are lending in alternate way to these capital seeking entities, how we can go beyond what data points we can look at to do a better underwriting and give capital that's posing more opportunity. And in that space only, we are extending this by our venture debt fund. So it actually gives fixed income, you may say, financing for venture capital. Those who do not want to dilute equity, it's given in the form of debt. Along with that, we also get warrants. The warrants, basically, for simplicity of, I don't like to use financial jargons. It simply gives you an option. If the company does well, we also are entitled to buy stock of the company at a discount. So all in all, on one side, I'm protecting the returns for my money. And two is, if there is an upside, I also have an option to get an equity. We feel in a year like 23 or 24, till the time we see more certainty to come in the capital structure, the interest rate rejig which is happening globally, I think that makes a good opportunity. So that's the one piece. I'll touch upon maybe briefly on the other piece, which is Varanium known for, which is the offshore fixed income. I think that is where 90% of our $1 billion AUM, which we manage, resides. And most of that would come from this region. I think most of us know us from Newport Global, which is the fund platform we use. Varanium is the asset management entity behind. I think there we clearly see the flavor is fixed income. And as Ram was highlighting, relating to the fact that while we all have the emotional element, or so to say, the home country bias, okay, wherein we would want to see our assets in INR also, because originally we originated from India and we want to see that in how that INR INR returns of ours are looking. But end of the day, if you see yourself as a global investor, okay, and forget we are fortunate, it's just purely incidental if you realize that we are Indians, right?
Correct.
So if you leave the emotions aside, okay, and look at purely from the standpoint of being a global investor, which is truly you are, okay? Today you are sitting in a global foreign land. And if you look at for your dollar investment, you will look at what is the best opportunity, okay? And there also India makes a huge case, both from equity, which we anyway heard through the day and we all know, but even from the fixed income opportunity side, the kind of returns one can generate. And there, I think when we put this layer of dollar-based investment, we look at the canvas, which is much wider.
Right.
Okay, just that restricting instead of one country, we look at the whole world where we can allocate the dollar capital and get maximum return for the same degree of risk. And that's where we play.
Brilliant. So that was lovely from you. Coming to you, Karthik, and all of you, kind of pitch in. Some of these fixed income instruments actually, let's say your latest credit fund, and he spoke about his venture debt fund, they kind of give returns of 16 to 18% with some coverage and so on and so forth. How really safe they are, okay? Because you're saying you got a 2x cover. Why would somebody borrow at such a high interest rate? That kind of always puzzles me, and I'm being an investor myself. Why would somebody borrow money at 16 to 18%, give you a collateral which is 2x worth? Doesn't he have options to borrow at a cheaper rate, Because as Ram also said, if the returns are not 16 to 18%, for NRIs, if I really look at making an investment in rupee terms and looking at the dollar depreciation, it just doesn't make sense if he gets a lower return of 7-8%. So how safe they are and why would somebody borrow? So love to get, because I think most of the funds here give similar kind of returns. Yeah, so love to hear that.
Okay, good question. I'm actually very glad that it came up in Dubai, because usually in my conversations so far, nobody's ever asked me this level of detail. The only thing people are focused on are the returns. So I'm pretty glad that your question is orienting around risk. Just the reason why I started this panel with India being by default a high yield market is because if you see, the stack of returns, I'm not going to talk about mutual fund debt returns or GSECs and any of that, because, those are AAA GSECs, and as somebody else said, those are not places that we play in. But if you look at, wholesale credit, whether it's real estate, corporate credit, mid-market, and so on, there are two broad things that are driving returns. And both of them are essentially what the banks, which are the public sector banks or the private sector banks, can and cannot do. Okay? So the first is that, wherever banks can compete in terms of lending, funds like us will not make money. They are the lowest cost capital providers in the country, and they finance everything from promoter equity to last mile. So wherever they can compete, we don't. That's sort of answer number one. Number two is, then what do we left with? There are large pockets of credit. For example, our latest mid-market lending fund, we call it the Emerging Corporate Credit Opportunities Fund, is focused on companies with turnovers of, let's say, between 100 and 1,000 crores in Indian rupee terms. So those are spaces over the last decade and a half where scheduled commercial banks have systematically vacated that space for a variety of cultural reasons, starting with SBI in the early 2010s, where they wanted to focus on larger credits, larger exposures, more concentration. I read somewhere in one of the earlier presentations, I think Saurav's only, where the concentration is quite rapid now, and the same 20% of the companies generate 70%. So the banks have somehow thinking that instead of a secular growth support in terms of credit, they should focus on the large, big guys, name lending, where somehow the credit is more attractive, and they don't have to worry about too much else. I'm being a little uncharitable, but the fact of the matter is that over the last decade and a half, the small to mid-market credit has largely been vacated. The second is, again, pretty unseen by the offshore market, but in the onshore, we are highly aware of it, is regulatory arbitrage, where there are things like acquisition financing, reorganizations, last mile, refinancing, top-ups, and so on and so forth. There are about 8 to 10 end users where the RBI has stipulated that the banks cannot lend because of the perceived high risk of those sort of end users. Now, this is actually financing to companies that don't have a bad credit history, are growing with visible cash, ability to offer security, and that's a huge pocket. We think that annual demand for mid-market credit somehow ranges, we think conservatively at Sundaram between 7 to 8 billion, but my worthy competitors think that it's in multiples of that. 15 to 20 billion is the latest Ernst & Young report on private credit. And so the regulatory arbitrage opportunities is sort of part of that. Real estate, if you see, again, where banks have stipulations on 5% of their net owned funds only going to that space, and within that they can only do construction finance. So the things that our real estate funds do are actually speaking significantly better from a safety point of view than what construction finance is, because we actually come in brownfield, so we don't take any pre-approval risk, we don't do land stage and so on and so forth, and we also, in every single one of our loans, have multiple projects collateralized to us. So we're actually doing enterprise level, multiple diverse cash flow backed funding at 18 to 20%. So these are purely as a result of what banks cannot do. So that's a huge driver of this opportunity and not reflective of the safety, but you got to be local to access these opportunities, move fast, ability to access, create a portfolio, create scale, because each of these are massively scalable opportunities. So even from a competition point of view, I think there are very few funds, despite all the noise around fundraising, the net credit demand for each of these ranges anywhere between 5 to 10 billion US. So, just in terms of secured lending.
So you're saying it's pretty safe as far as your funds are concerned?
Nothing is really safe, because if anybody pays you 18 to 20%, nothing is risk-free. But yes.
Yeah, so relatively, it's lesser risk. Love to hear from you, Vineet, how you manage risk, because I think high returns, we all love it. Sometimes I feel it's better than investing into equity as well. When I saw a 20-year number, and if you're getting 16 to 18%, why should the heck I invest into equity and try to pick brain? India is better, China is better. Here I invest 16 to 18%, sleep well at night, get my cash flows every quarter. I'm a happy person. So how do you manage risk? Because you do a very different kind of stuff to what I will hear from Vishal as well. He does the venture debt, but yeah, how do you manage risk?
So from our perspective, I think Karthik spoke about the demand of money side of the issue, which is that today if banks are not there, whom do you turn to, and therefore you end up paying a higher price for it.
Correct.
The other side is also what the business can afford.
Right.
Right.
Exactly.
And fundamentally, therefore, is the ROE or return on capital invested big enough, right, to justify the fact that you can borrow at 13%, 15%, 17%, right? Now that question is that's the key part that we spend a lot of time on. The business fundamentally has to have an ROE or an ROCE, more correctly,
right,
which is good enough for the guy to borrow at 13, 15, 16% and still make a lot more money on that.
right.
Right. Today, to put this in perspective, India has, my colleague spoke about 100 crore and higher, right? Now India has 18,000 such companies. 18,000 such companies have an aggregate borrowed $100 billion. That sounds high, but it's only $6 million per company.
Correct.
Which is nothing. That only translates to a debt. For every $100 of equity they put in, they can only get $40 of debt.
Right.
And most of that comes from the neighborhood public sector bank,
right,
not the private sector, not people like us on this DAIS, right? It shows a very deep problem, and it seems to indicate that if that 100 billion were to grow at the compounded credit rate that India is seeing of 18%, right? The need for money is actually far, far higher than any estimate that EY has put out for private credit, right? And it's happening because the underlying ROEs of this business are 30-40%.
Right.
And that's why today, given the kind of growth that India can see, that translates to a relatively higher price for credit that these companies are willing to pay. And that's what we have to underwrite.
Perfect.
Right? The cash flow, the kind of return on capital that they can provide, and of course, coming back to the first point, governance has to be good.
Perfect.
So today we have a team of 40 credit managers that conduct four diligences per company per year on the field. That allows us to narrow down on this point. One, is governance good? Two, can the company afford credit?
Correct. Great. And a question to you. Yeah, sorry,
Just
go ahead. Yeah,
just wanted to
yeah,
add
no,
one
please,
thing on this. From the manager's perspective
Right.
and from investors' perspective,
Right.
right? I think a lot of time investors think, how can we avoid risk? Right? I think what is more important in investing is not how to avoid risk, but how to manage the risk.
Correct. I fully agree.
It's very difficult to avoid risk completely, but if you can manage it well, then I think some of these returns are.
I think Ram, you very well said, how do you really manage risk? But sometimes, let's say the underlying collateral is given is the equity stock of the company. And if everything goes south, you just can't do it and anything, So I get really, really worried, although I've invested into several venture debt myself. But I wonder when a startup is in red, okay, it borrows money at 15, 16, 18, 20%, sometimes 13%. How do we expect them to repay us? I'm sure there are enough legal clauses which you put in to ensure that the first money comes to you. But obviously there is a risk which I feel is very, very high, although I invest because we're all greedy, we want higher returns. So how do you really manage risk?
Okay, I'm glad firstly, Vidin, usually when we talk about products, we focus more on the written side of it. Along with it always comes risk, and we are talking about the risk, and ask this question particularly to all panelists. So that. Now, as Ram said, okay, if you want low risk, there will be low return.
Correct.
Because you're seeking high returns, you have to live with the risk.
Correct.
Okay, if you want absolutely risk-free, invest in treasuries, invest in fixed income, pure fixed income, lower the investment grade, and hence your returns will be lower. But if you're seeking a double-digit return, assume that there is a degree of risk.
Sure.
Now, risk is mitigated by two things. One, the diligence, as you heard just Karthik and Avneet both highlighted. The diligence, while you select the underlying credit, your companies where you're investing. That is part one. The part two is diversification. So whenever you don't lend it to one company, you lend it to portfolio of 20, 30, 50 companies, or more you diversify, that is how the risk is mitigated. Now, unlike in case of equity, wherein too much diversification beyond a point does not help, it reduces your return. In case of fixed income, that's not necessarily the case. However, the diligence here is far more. Okay, so you just heard him, 40 people, 4 times a year. After every, I'm assuming after every quarter, they must be doing the diligence on the ground. And mind you that this is not all data which is available like equity on your fingertips. You just did an Excel-based calculation. They'll have to fetch the data, do their analytics. So it's far more research intensive. Now here in case of venture debt, what we look at as, of course you highlighted, so this is the core tenet, okay? So the diligence and diversification. Now here, especially in case of venture debt, we would be still going at the core of what you will look at to invest in the venture equity. The first in place, the opportunity, TAM, the promoters, what idea they are talking about, how is the scalability. So all the basic tenets will be still looked upon. And then we focus a lot on unit economics. So our fundamental thesis, how we will give money in form of venture equity, does not change. On top of it, we have added another layer. We are saying how the interest will be serviced, okay? And to that, we have diversified this approach also in two-pronged. In one, we are saying venture debt or financing part of it. The other is we are doing revenue-based lending, okay? This is a little relatively new concept which is picking. By the way, in the mature markets, or I may say relatively more mature markets, because India now, catches up what US does in 10, 20 years, perhaps India would tend to do in 2 or 3 years, because we are very fast thanks to the technology and the way we have far superior managers. I think today, the way we are progressing, we can catch up that space very fast. So India today is in a 1/10 of the scale where US is in terms of venture debt financing, which is the next big thing in terms of the money management there. Here, the revenue-based financing, similar to a GST or a tax, or you have, the moment there is an invoice, you see those heads deducted right away then in your invoice itself, okay? Behind this invoice, whenever the revenue is generated, a small deduction for the cost which you have taken in form of revenue-based financing is also deducted, and on a very frequent frequency, it can be as frequent as 1 day or 1 week or 1 month, you can keep paying, see the overall revenues, and keep paying that to the lender. So that actually helps to identify whether I am able to give money to a company which is positive on unit economics. At the same time, I have a very strong hold on the company's business as such on a real lifetime basis. So as Saurabh was highlighting about how the banks can track, thanks to GST, the transaction-wise movement by a company, so do we, okay? It helps in a way that revenue-based financing, by the way, does not have any covenants also, okay? Because typically when we do financing in terms of any debt debenture, then you write covenants. Covenants are basically the terms. In simple, crude terms, we may put across the terms, and whenever we have to have terms, bilateral terms, it takes a lot of time to agree because you have to negotiate. Of course,
Sure.
for my investors, will always want very tight terms, whereas the promoter may not want.
Great.
Here, I'm simply linking it to revenue. You make the revenue,
Perfect.
you give me my 10 basis point, and that services the loan. So in that way, it kind of covers for the
Correct.
underlying risk. Otherwise, as I highlighted,
Right.
covenants-
It's always a risk. Great. So Ram, coming to you, you guys have been offering equity funds, dollar-denominated funds, so how do you really run the process? Is the way where you technically hedge the, dollar rupee? Because when you say dollar-denominated fund, eventually you are investing into an underlying, which is a rupee fund, right? It's a rupee asset.
It's a rupee asset.
So how do you really run this? So how does the investor get protected just in case for any, we all know rupee depreciates every year. There's nothing new about it. So how do you really run that?
Sure. Thanks for asking that question. Just before I answer the question specifically,
Sure.
just to highlight a little bit of a background about
Right.
this. As the asset management business, Aditya Birla Sun Life is a joint venture between Aditya Birla Group
Right.
and Sun Life Financials of Canada.
Sure.
And in 2011, as the business, we decided to set up offices in Dubai and in
Right.
Singapore. The primary reason and the thought was thinking about offering dollar-denominated solutions
Right.
to the global clients, including the NRIs.
Right.
And so that we have the ability also to serve them from two offices
Right.
in Middle East and in Asia. We reach out to institutional clients, individuals, family offices, and so on. And in 2014, when we launched two of our funds, India Frontline Equity Fund and India Quality Advantage Fund are the two funds that we have. One is a large cap oriented fund, more disciplined in nature, follows the MSCI India index. And the other is, which is India Quality Advantage, more small and mid cap oriented, sector agnostic, follows the MSCI small cap India index. The idea of launching these two funds was to give the coverage of entire India capitalization
Sure.
between large, mid, and small to the investors globally.
Correct.
To answer your question specifically on the dollar side, idea is not to protect investors from the currency risk.
Okay.
As you rightly mentioned, we do not hedge the
Okay.
currency here. Idea is when I initially spoke about two portions of my asset, right?
Right.
One which is meant to be used in India and other which is not meant to be used in India
Right.
and meant to be used outside India.
Sure.
Idea is to offer these products for that particular pocket of my
Right.
asset. In that pocket, if you ask me, there is a fine balance between safety and returns.
Right.
I can be, if I'm too particular about, let's say, not meeting with an accident, I might be driving a Maruti 800.
Right.
But that does not probably take me to my destination within the time frame that I'm looking at.
Sure.
But if I am planning to drive and get the thrill of a Ferrari, I just need to ensure that I have enough safety measures put in place so that I do not meet an accident.
Right.
Does that avoid meeting an accident completely? No.
No.
But if you are there for a relatively long period of time, you will ensure that you will be able to navigate ups and downs of the markets considerably well. Just to give you some data, I came here in 2011 to work with this organization. At that point in time, the rupee dollar was approximately 55. Today, the rupee dollar conversion is approximately 82. So we have depreciated by more than 50% in last 10, 11 years.
Right.
But despite that depreciation, the dollar return in the equity funds has been close to 13 and 14%.
Dollar
for most of
returns.
the funds. And these are dollar returns despite rupee depreciation.
Right.
Right now, choice for you is, if you want to avoid this 50% depreciation, whether you go into an asset class which can give you only 5, 6, 7% dollar,
Right.
or you say, I am willing to take that risk, I know what are my safety measures, but I want to earn that 13, 14% returns. And then you still look at some of these dollar-denominated funds.
Got it.
So we do not feed back into the funds in India. We have our own equity portfolio, but as you rightly said, the investors would still be exposed to the currency risk.
Right.
Because we will take the dollars, invest back in India by converting them into rupee, but it gives a lot of operational convenience.
Understood.
So instead of you converting the currency,
Correct.
sending it back and then bringing it back, having the PAN number, having to file the returns in India,
Yeah.
the operational convenience that you get by investing in dollar, getting back your dollars when you want, without those operational hassles is what we are trying to convey to our investors here.
Perfect.
And been very successful in that.
Wow. Wow. So this is very helpful to investors. They have money in dollars. They just put this. So these structures which you guys follow for dollar-denominated funds, so are they now a gift city structure, or are they kind of a Mauritius structure? How do you really do this? So if I'm a guy sitting in Dubai, how do I kind of really make an investment in any of your funds? What's the way to do it?
So if I can start and then maybe my...
And all of you, I need to know from all of you because
Sure.
I'm sure a gift city is another option. Mauritius is another option, Cayman Islands, there are Singapore, or how do you really do this?
So just to, on a broader basis,
Yeah.
a lot of these domiciles,
Right.
they do not give you any returns advantage.
Correct.
Right? The only thing is the operational convenience that I as a manager look forward to.
Right.
And maybe as a manager, if there are more convenience in terms of easy conversion and so on, the cost part of it. The funds that we manage, both the equity funds, are domiciled in Ireland under
Right.
the UCITS compliance. UCITS
Beautiful.
is equivalent to Indian mutual funds compliance.
Right.
The reason is because globally, UCITS are the most well acceptable regulatory compliance in the world.
Correct.
The moment you say I'm a UCITS compliant fund, you have an entry in any of the investors' scheme of things. But yes, till to about 2011-12, we used to have an equity fund from Mauritius. We still have. Mauritius has been through thick and thin of regulatory gray clouds across the world. But you can structure the fund in any domicile.
Perfect. Great. Over to you, Vishal.
Okay, in our case, I completely agree with Ram. So UCITS is, of course, the platinum grade, and usually for the larger funds, especially equity, they prefer the island UCITS route. In our case, we, as I said, that the smart money, because these are more transactional, smaller in size, and there the efficiency become more critical because these are quick and has to be efficient in terms of cost.
Right.
So we find that Mauritius and Cayman, these are far more cost efficient, and that's why we use them. We have Singapore setup too, which is we can use that as well, but we find it's onerous and far more. It's not as cost efficient. Of course, gift is the way forward, but we are in a wait and watch mode right now because it's still to evolve. What we particularly feel, because as Ram mentioned, in terms of the tax implications is one and the same across all these jurisdictions. Okay, what is more critical is we have seen that especially the NRI community, they love to have this offshore jurisdictions preferred because one, these are dollar denominated. Two is the tax part, which is we all read, okay, especially to deal with the extra leg of documentation in the paperwork or tax regime. That is also evolving now in India.
Right.
That's how Mauritius and
Right.
Cayman
Beneath your funds.
We have used Mauritius in the past,
Okay.
but we have now doubled down on Gift City.
Gift City. Great.
Right? We think that the regulatory certainty that we will get in Gift City will be much higher. The taxation certainty we will get in Gift is much higher. And most importantly, one of the oft-used structures that we have now started to pick up is where there is a blocker, which means that the tax rate is exactly the same irrespective of who is investing from where.
Right.
That gives us significant fundraising flexibility. And that allows us to go into multiple domiciles without any concern that the so-called end outcome can be different or the NAV is different. So we have doubled down on Gift. I do recognize that it's relatively early days for Gift, but having said that, we are now seeing some of the largest fund managers globally starting to navigate to Gift, given the openness of the regulatory architecture, single window clearance that's got announced, openness of discussion with regulators, and the clear intent to rival some of the largest centers globally that we see from the authority and the government there.
Just to add this, Vineet, I just want to, because it's Gift City, I'm just more keen to know. How does an NRI react saying, oh, this is money is going via a Gift City? Do they take it positively? Or they kind of say, oh, this money which may not be, may not disclose. How do you really perceive Gift City as the origination? What is there, what kind of reactions you get from the clients?
Yeah, I think great question. And I think the area where Gift has to develop very significantly is about recognizing ISINs, right? The single fact piece that we hear from any client in this part of the world or Singapore is that they would like to see their asset reflect on their custody statement.
Perfect.
Right? And now the Gift authorities have gone halfway towards it. They have not gone 100%, so it's not entirely seamless. We try to bridge the gap through a digital onboarding process, but it is not the same thing.
Okay.
The day a gift ISIN becomes globally recognizable and can be seen on any private banking screen, we are there.
Karthik, what do you
Okay,
guys?
I think our experience has been quite the same as Vineet's. In fact, of the 4 funds we've launched on the private credit side, the first one we used a Mauritius feeder vehicle. Obviously they weren't, it wasn't structured for Forex. People were willing to take the rupee risk. But I think, the new funds, over the last 6 months or so, we've been talking about, positioning ourselves in gift as well for quite similar reasons. Of course, Sundaram has an AMC in Singapore. We are mass registered, so, we have an ability to do that. But I think being local, I think the gift probably makes more sense for us right now.
Right. I just want last question, to be answered. A quick 30-second. One reason why should an NRI invest into India fixed income or an alternate product? Just 30 seconds on that. Why should they invest? Why should they consider seriously investing into India fixed income besides corporate, the bank fixed deposits? Why should they invest?
So I think the quick answer is that it's an asset allocation question. And obviously, the predictability, the visibility, if you, as I started this conversation, if you bet on the equity, if you bet on India, you should bet on credit as well. And if there is a way that the structure can deliver risk-adjusted returns adjusting for Forex, then I think it's almost equity type returns with debt type risks.
Great.
8% plus returns with stability, predictability, and capital protection.
Brilliant.
I think same. I think this is a, I may say, a lifetime opportunity. Since 2008, 23 poses an opportunity where we are at 2 or 3 standard deviation on across fixed income yield curves, whether you look at 3-year or 10-year or 30-year. Okay, you are in 2 or 3 standard deviation. So it's kind of one of its kind of opportunity. You're simply coming for yield, whether you look at 8 to 10%, which is the broad key spectrum where we operate, or we look at very specific yield-based assets, which are giving me, as I say, 16 to 18% return as well.
Great.
So purely for yield, I think today you can't get this kind of, with equity you lose sleep. You see the volatility, which is not here.
Right, Ram.
I just want to add on all of three's view. I think as an investor, I look at it as and not either or.
Okay.
Okay, I say that for me to have my investments in fixed income across the spectrum of risk and return, India fixed income has a space and has a place for you to look at it, because you are not saying that if I have $100 to invest, either I'm investing entire 100 or I'm not investing entire 100.
Brilliant.
You look at your risk return profile, you say that out of this 100, can I invest 10, 20, 30, 40, 50? And that's the way you have to form your decision.
Lovely. Thanks for summarizing it. Lovely. It was 3 takeaways. Gift City seems to be coming up. India debt seems to be coming as a mainstream. So thank you very much for your kind of valuable inputs. I'm sure it was helpful to a lot of people. Thank you very much for your time, and it was lovely talking to you guys.